Uh, Good afternoon, everyone. It's a great pleasure and honor being here for the first time. I was always meeting Steffi and Yossi in Davos, and they were always telling me, come here. And I said, I'm an old fart, and I don't know anything about technology, but then they insisted, and I tried to be here and speak in front of this great crowd. I would like to talk, I have only 20 minutes, about the world economy, and I want also to speak not only about the short run, but also on how trade, globalization, and technology is going to affect jobs, incomes, and the future of the global economy long term. So then I'm going to be able to talk about the short term and the long term in 20 minutes, but I'll give it the best try. Let's start with the short term. The year has started with a significant amount of global economic and financial turmoil. Markets are very volatile. There's been a massive correction in US and global equity prices. And there are many questions on people's minds about what's going to happen to the global economy this year. Is China going to have a soft landing or a hard landing? Will there be a collapse of their stock market and their currency and of their economy? Has the Federal Reserve made a mistake by raising rates now? Should have waited longer, given the US economy is slowing down. What are the problems of Europe and the Eurozone? Some people believe there will be eventually a collapse of the Eurozone and of the European Union, the risk of Brexit, the risk of Grexit, now the migration crisis, terrorism, populism, austerity and reform fatigue in the periphery of Eurozone, bailout fatigue in the core of the Eurozone. With this collapse in oil prices, what does it say about the global economy? Is it a supply story? Is it a demand story? Why emerging markets were growing very fast now are sharply slowing down? Is it cyclical or is it structural? Is it going to be a financial crisis in these emerging markets? And of course, in addition to economic and the financial risks, there are also geopolitical risks. What's happening right now in the Middle East that is burning and potential for contagion in financial market and the economy, the risk of terrorism, the Russia-Ukraine conflict and the fact that the Russian bear is becoming more aggressive, the political problems of Europe and the Eurozone, where you could have disintegration and balkanization, and of course the implication of the rise of China, and is it going to be peaceful or not? Lots of geopolitical questions. And therefore people now are asking the questions are we going to have another global financial crisis? Are we going to have another global recession? Are we going to start to have a correction in equity market, or are we going to be at the start of a rout, of a new bear market? Now let's talk about the recent turmoil and what are the causes of it, and try to understand what's going on right now. First factor, of course, is the worry about the Chinese hard landing, of a collapse of its economy, of a recession in China, of a collapse of its currency, and a collapse also of its stock market. I think that markets a year ago were too optimistic about China, believing in a soft landing. Today they are too pessimistic. They believe in a hard landing in China. I've always had the view that China is going to have neither a soft nor a hard landing, what I call a bumpy landing or a rough landing. Growth this year maybe 6%, going towards 5% by the end of the decade, because potential growth in China has slowed down sharply. So it's going to be rough, yes, but it's going to be a collapse of China that leads to a collapse of emerging markets and a global recession. I think that's a tail risk with low probability as of now. Of course, emerging markets are doing poorly because a bunch of tailwinds globally are becoming headwinds. China's not going to grow any longer at 10, 11%, at best 5, 6. The Fed is going to exit zero policy rates, and money is now flowing out of emerging markets. And the commodity super cycle is over because of supply and demand factors. And many of these emerging markets that made policy mistake, loose monetary fiscal credit policies. And many of them did not do the structural reform to increase potential growth. Now that potential growth is falling. So emerging markets are fragile. The US is a mixed bag. The non-traded sector is doing well, job creation is there, manufacturing and traded sector is weak because of low and falling oil prices. It is hurting the oil and energy sector because of a strong dollar. This is hurting the trade balance of the United States and manufacturing. In my view, the Fed made a mistake by raising rates when there was no inflation, and now this year they'll have to stop. Because given the turmoil and given the weakness of the US economy, growth close to zero in the fourth quarter, probably very weak in the first quarter, the Fed is not going to hike as much as they want. They might even have to reverse themselves. Why is oil prices falling, and is it a good sign or bad sign for the global economy? If the price of oil is falling because there is too much supply, on net that's bad for producers and net exporters, but it's good for the global economy, because you're redistributing income from those who are saving it, all exporters, to those who are spending, that are all consumers. However, lately I think that the reasons why oil prices are falling is not just the glut of supply, but also lack of global aggregate demand. China is slowing down, emerging markets are slowing down, even the US is slowing down. And if the fall in oil price is a signal of weak global growth, then it's a negative. And that's why stock markets, the US and globally, have reacted negatively to the recent fall in oil prices. It's a signal of weakness in global economic growth. This fall in oil prices also leading to stresses in credit markets and in bond markets, especially in the United States, where there was too much leverage and debt and risk-taking by all energy and high yield and highly leveraged corporates that now are in a more fragile situation. Even earnings and revenue growth, bottom line and top line revenues of firms are slowing down for the first time, and that's one of the reasons behind the market correction. And finally, there is a whole set of problems in the Eurozone. Weak economic growth, lack of structural reform, the risk of terrorism, the migration crisis that remains unresolved, the risk that Brexit has been only postponed and not avoided, and the risk that if the UK is going to have a referendum this year on Brexit, a majority of Brits might vote to exit the Eurozone, the European Union. And that could be the beginning of the end of the European Union, could be the beginning of the end of the Eurozone if Brexit does occur. In the periphery of the Eurozone, there is now austerity and reform fatigue. You see it in Greece, you see it in Portugal, you see it in Spain, you see it in Italy. But increasingly, there is also bailout fatigue in Germany, in the Netherlands, in Finland, in the core of the Eurozone, where they say enough of is enough of bailing out this country or not doing reform and austerity. At which point, reform and austerity fatigue is going to clash with bailout fatigue, and it's going to lead to tensions within the Eurozone. I think what's going to happen in Germany is going to be very important. So if you think about this outlook, then you have to ask yourself the following question. What's going to happen to the global economy this year? For now, has been a mild economic expansion since October. Positive growth that was beginning to accelerate. But like last year, shocks like China and others can lead to a deceleration of growth, and this expansion becoming a slowdown. And I think that's the most likely scenario. So we're going to go from an expansion to a slowdown, and the question is, are we going to go to an outright contraction, a recession? I would rule out a recession scenario because that would require a collapse of China, a collapse of emerging markets, a stall of growth in US, Europe, and Japan. It's a tail risk, but a 20% probability. But this expansion that was already lukewarm and anemic might become an economic slowdown. And if it becomes an economic slowdown, the correction in global equity market could become a bear market. And if it becomes a bear market, it's going to feed back to the real economy, leading to another loop downwards in economic slowdown. So that's a risk for this year. So the good news is that we may not have another global recession. The good news is we're not going to have another global financial crisis. The bad news is there will be a significant economic slowdown, and this is going to be a bad year for asset prices. Now, if I had to describe the global economy, the IMF calls it the new mediocre. I call it the new abnormal. Why the new abnormal? For a number of reasons that are important. First of all, potential growth, both in advanced economies and emerging markets, has fallen for a number of reasons. Part of it is demographics. Part of it is the rise of inequality that reduces consumption. Part of it is globally, there is too much savings, there's too little investment, there is too much supply of goods and services, and there is not enough aggregate demand. So potential growth in advanced economies and emerging markets is now lower than before, in spite of technology that so far is not increasing productivity growth. Secondly, actual growth for a number of years is going to be below potential. That's what's happening in the US, in Europe, and what's happening right now in emerging markets. Why? When you have too much debt and leverage, you have to deleverage, and deleverage means to spend less, to save more or save less, and that implies 5-10 years where growth is below potential as this painful process deleveraging occurs. It started in the United States, it spread to Europe, and now is the lag of China and emerging markets are deleveraging, and therefore their actual growth is going to be for a number of years below potential. Moreover, the other abnormal part of this global economy is that monetary policies are becoming increasingly unconventional. Terms that did not even exist 10 years ago are now the norm. Who had heard 10 years ago the term ZIRP, zero interest rate policy, the term QE, quantitative easing, the term CE, credit easing, the term NDR, negative deposit rate, the term FG, forward guidance, or FX intervention. This is totally unconventional monetary policy and is becoming the norm. It's going to stay with us in US, in Europe, in Japan, in the smaller European economies, and around the world. We have even this paradox that today there is about $2 trillion of long-term bonds in Europe and Eurozone and Japan that have a negative nominal yield, You can borrow at negative interest rates for 10, 20% in Switzerland or other parts of Europe and the Eurozone.
Now, some people argued incorrectly that all this easy money, all this debasing of fiat currencies by central bank, they argued incorrectly that would lead to inflation and hyperinflation, that it would lead to asset prices like bond yields rising through the roof, that would lead to a collapse of the US dollar, that would lead to the value of gold going through the roof. And it will lead to fiat currencies debased by central banks being replaced by cryptocurrency like Bitcoin. But look at the data. Just the opposite has happened. Inflation not only is low, but is falling. There is a risk of deflation, not of high inflation. Interest rates, instead of going higher on the long term, are going lower. And as I pointed out, throughout the world, you have negative long-term interest rates for $2 trillion of government bonds. The value of dollar has not collapsed, has skyrocketed. The value of gold has fallen by more than 50% in the last 2 years. And guess what? Last year, the worst performing currency in the world, if you can call it a currency, was Bitcoin. They lost 2/3 of its value. So much for fiat currency being replaced by cryptocurrencies. So what has happened? Why all this easy money, doubling, quadrupling, and more so of base money has not led to inflation? It has not led to inflation because we live in a world when there is too much supply of goods and services. There is excess supply of labor. There is an excess supply of commodities. There is an excess supply relative demand of housing and real estate. And therefore, there are pressures that are towards low inflation, and deflation. And central banks, to avoid deflation, are aggressively going to zero rates, negative rates, quantitative easing, credit easing, forward guidance, and a whole slew of unconventional monetary policy. So the causality is not going from money increasing causing inflation, but the lack of inflation causing central banks to become increasingly unconventional. We live in a world in which there is a global savings glut. There is a global investment slump, where there is too much supply of goods, services, labor, and so on, and not enough demand for goods and services, in part because we have the mistaken policy mix. Too much reliance on monetary policy, too little reliance on fiscal policy, infrastructure spending, and things that boost aggregate demand. And that's the world we live in right now, of a conventional monetary policy. This is also the reason why inflation, instead of going higher, has been going lower, because there is not enough demand, there is excessive supply. There is no inflation in goods, there is no inflation in services. What there is asset inflation. The central bank policies of unconventional monetary policy have led to asset inflation, while the real economy is still mediocre. And this asset inflation may lead to asset reflation and eventually to asset and credit bubble. And if this asset and credit bubble were to build over time, you could have a risk of another global financial crisis, not this year, but 2 or 3 years down the line. So the paradox, no goods inflation, but asset inflation. So we have this paradox that while Wall Street is doing well, because until the recent correction, asset prices were going higher and higher, Main Street was actually lukewarm and anemic. And there is this gap between what asset prices are and their fundamental value. And this gap between Wall Street and Main Street implied that eventually a correction downward in asset prices has to occur, like the one that started at the beginning of this year. The other paradox of this new abnormal is there is a lot of geopolitical risk in the world, but they don't seem to have an impact on the real economy or financial markets. Whenever there was turmoil in the past in the Middle East, it led to a stagflationary oil shock. You happened in the Yom Kippur War of 73 with the stagflation of 74, 79, 74, 75. It happened after the Iranian Revolution. It happened after the Iraqi invasion of Kuwait. Today is the paradox that we have the entire Middle East is burning from the Maghreb all the way to Afghanistan and Pakistan in between, and in spite of that, oil prices are falling. Why? There is a glut of supply, shale gas and oil, and new technologies in North America, but also glut of supply from Latin America to East Africa and around the world. So the Middle East might be burning, but oil prices are falling lower and lower. It's a supply story, but also weakness of global aggregate demand. Let me briefly say something about the long term of the global economy. Now, if you want to be an optimist, you point out there are many things that are positive, medium, long term about the global economy. The first one is technology. There are many industries of the future, ET, energy technologies, shale gas and oil, clean tech, green economy, BT, biotechnology, biomedical research, and all the things that are going to make us live longer and healthier. Of course, IT, information technology, Web 2.0, 3.0, cloud computing, Internet of Things, and all the apps and technologies that are going to change the world for the better. MT, manufacturing technologies, robotics, automation, artificial intelligence, 3D printing, personalized manufacturing, and so on. but also FT, fintech and financial technologies, and how they're going to change financial markets and asset and banking. And finally, I would say also DT, application of tech to defense system, because in a world in which there are geopolitical risks, of course, even defense systems are becoming more technological advanced, like drones and so on. So you have at least 6 industries of the future, and people say they're going to change completely productivity, the way we live, we work, and so on, for the better. That's positive. Second positive, there's been a global economic recovery since 2009, economic but also financial market recovery. The balance sheets of corporations and their P&L is positive. They're sitting on trillions of dollars of cash and profits. If they're becoming more optimistic about the future, they can spend more. They can do more capex, more hiring, more M&A activities. Emerging markets might be right now wobbly, but they're going to be a rising part of the global economy. Population dividends, middle class, consumer society, eventually more than half of global GDP is going to be emerging markets, and most of global growth is coming from emerging markets. Trade and globalization are still ongoing, and that's positive for the global economy. And demographic trends imply a population dividends in emerging markets, and the fact we're going to live longer and healthier, maybe until 80, 90, or 100, given the new biomedical research. These are the positives. But what are the things you have to worry about the global economy in the medium long term? First of all, think about this technological innovation that everybody here or in Silicon Valley is giddy about. Unfortunately, these technological innovations are becoming increasingly capital intensive, skill bias, and labor savings. So if you're an owner of financial and economic capital, you're going to do well. If you have skills like all of you here, you're going to do well. But if you're a low, middle-skilled worker, blue collar by white collar, your jobs and incomes got displaced by technology. Secondly, inequality is rising because of trade, because of globalization, because of technology, but also because of winner-take-all effects, the superstar effects. Whoever is the top in their own field, it gets the economy of scale of a market of billion people. 3, the future of jobs and incomes. Technology, robotics, automation eventually is going to replace most jobs. Already half of the jobs in the US in the next 10 years could be replaced by technology. So there'll be a lot of output, but there'll be a distribution issue of it. Those who have capital and skills are going to do well. Those who don't have capital and skills and have only low labor are going to do poorly in terms of income and even losing jobs forever. There are problems with demographics. Yeah, we're going to live until 100, but can we afford it with the cost of healthcare and pension systems that are unfunded? And in emerging markets, this population dividend can become a nightmare, like we saw in the Middle East, because if people are young, hungry, unemployed, unskilled, and they don't have jobs, eventually revolutions occur. Additional stresses. There is too much debt and leverage, private and public sector in the global economy, and that leads to repeated financial crises in advanced economies and emerging markets. And financial crises are becoming more virulent, more violent, more frequent, and more damaging in terms of economic and social costs. And the combination of all these factors imply that there is rising social and political instability around the world, both in advanced economies and emerging markets. Populist parties of the right and the left that are against free market, against technology, against trade, against globalization, against migration are becoming more popular in the core and periphery of Eurozone, in the US with the Tea Party, in the Middle East, even in Asia. And that's going to become social and politically a problem. If inequality rises and we don't find a way to make sure that trade, globalization, and technology benefits all, eventually there will be a backlash against globalization. And finally, in this world in which there is disruption coming from technology, rising and falling firms, but also entire sectors, even entire economies, there is rising geopolitical risk. We live in a G0 world in which there is no global leader, there is no global hegemon, and the global powers of the world live in a situation of rising economic, social, political, and even geopolitical conflict. So I know that technology can be making us all better off, but some of the consequences of technology for jobs, for income, for inequality, for distribution of gains, for social and political instability are things that have to be discussed. Okay, thanks very much for your attention.